At this year's medium-term budget policy statement, a key anticipation was the announcement of a new inflation target. The National Treasury delivered on this by formally adopting a lower inflation rate target of 3%, down from the previous target band of 3% to 6%. This is an important event for investors in South African assets. For many years, South Africa has operated with a higher inflation target relative to our emerging market peers. The lowering of our inflation target to 3%, with a 1% tolerance band on either side, brings us more in line with our trading partners and increases relative competitiveness. Low and stable inflation leads to less economic uncertainty, which in turn encourages productive fixed investment that fosters economic growth and job creation. Furthermore, a major positive of lower inflation is the assistance it provides to the fiscal framework pressures. As pointed out previously, low inflation leads to stronger economic growth that filters through to higher tax revenues. This creates meaningful headroom in the sovereign's finances, allowing government to better meet interest and expenditure costs. Additionally, low and stable inflation results in a compression of inflation differentials. Investors begin to price in this positive dynamic, compressing embedded inflation premiums across the yield curve. This drives yields lower, reducing the borrowing rate at which National Treasury issues debt. The results are a declining debt service costs and important fiscal gains. What we begin to see is the start of a strong and reinforcing feedback loop, where an uptick in growth and a reduction in interest payment burdens leads to a more credible and sustainable fiscal framework, which investors reward further by discounting additional country risk premium. We stand cautiously optimistic and are pleased that the SARB and the National Treasury are aligned on this inflation objective. Clarity and credibility will be crucial in driving inflation expectations lower, while steadfast political will and capital is needed to address the inflation risks posed by administrative prices and public sector wage growth pressures.